Russell's ripping, breath is improving. The market's taken a pretty drastic shift in tone over the last 3 trading days. Let's talk about how that affects the calculus of investing home versus abroad. Joining us, Andrew Skatoff is the founder and chief investment officer at Bancreek Capital Advisors at our spot, the New York Stock Exchange. Andrew, welcome to the show. Thanks for being here this morning.
Oliver, thanks for having me.
So let's kind of first talk how you guys are thinking about, I mean, it's a short-term thing, but after months of the market being so skewed in one direction, to see this massive pivot the last 3 days, what do you make of it?
Sure. Well, I would start off by saying we certainly take a long-term approach to investing. And whether it's in our US ETF or our international ETF, BCIL, the focus is finding these structurally advantaged business models that can compound our capital over time. So we always think there are interesting opportunities internationally. Sometimes it takes longer for the markets to appreciate them.
Okay, and right now they're certainly appreciating, I guess, inflation, maybe November. Some can argue kind of back and forth, but the core of it does seem to be inflation related. Does it make that big of a difference to lock in, a September cut, 25 basis points? Like, does that change the math on debt and on quality versus not? Or is the market thinking once we start cuts, we're never going to stop?
Yeah, I mean, look, I think the thought process is, once the Fed starts to signal that it's time to ease a little bit, even if it's just 25 basis points to start, I think the markets would be obviously quite receptive to that. And I think that ultimately unlocks potential value in the international markets as well. Obviously, currencies could improve a little bit. There's been significant currency weakness over the last couple of years internationally. So I think, if you have a kind of shift in rate policy, that's certainly going to encourage additional investment abroad, I would think.
Okay. So the theme so far up until this point, the international story has kind of been the only central banks that are easing with Europe, with Canada. That's kind of helped. Bank of Japan, kind of its own story, but it's worked there for their stock market. So if the U.S. does start easing, does that lessen any of the appeal for international?
Yeah, I mean, look, I think in general, it feels like at least they try to work in lockstep with one another. Like, no bank really wants to get too far ahead of one another. So it feels like, in the US, if we start to cut, you'll start to see that kind of gradual improvement or easing globally. So that's kind of what we think will happen. Again, the types of securities that we're looking at and that we select in our quantitative approach are businesses that have been around for decades, and in some cases like 100 years. So they've been able to weather the storm through all different cycles. So it's really about kind of continuing to compound their edge that they've developed over the years, and we think that they'll continue to do that regardless of the interest rate environment.
Okay, so tell me about your approach in the international fund. Walk us through kind of the strategy, because you guys just launched this year.
We did. So we launched our flagship last December, and that was the large cap US, BCUS, and then BCIL we launched in March. But really this has been a process that's been going on for years. Before starting the ETF platform, we had been running capital for other family offices. And really the focus was finding businesses that can compound capital over, again, cycles and decades, if you will. And so the process hasn't really changed all that much. We're using data, a combination of fundamental data and then quantitative metrics that we've kind of developed internally to find signals that these businesses kind of pulse out to the market that say, like, hey, we're an interesting asset to dive into, or this is something is special or unique about our business model that has allowed us to grow over long periods of time. Like, the way I frame it, and I think an easier way to explain it is, if you have two assets and let's say they both grow 15% over a 5-year period on average, but one's growing 30 one year, then down 10 the next year, and then up 10, and all over the place, and one is kind of more like 15 almost every year. In our view, the one that's growing at roughly 15% every year has a higher probability to continue that, because there's something structurally in their business model that's allowing them to continue more consistent, less volatile growth. And so that's kind of the framework that we overlay in the US markets and then also international. So it's really no different whether we're looking and hunting for businesses in the US or abroad.
Okay. And you're trading at highs right now. Is that coming from any particularly strong picks that stand out? Any names that we should be paying attention to?
Yeah, and so it really is more a function of the process as opposed to individual names. If you look at like BCUS, for example, we do have a fairly high exposure to industrials at the moment. And I would just say industrials in general tend to be more of like a catch-all for the businesses that don't have very specific sector designations. And so, again, and I would say that they're not really related at all. And so you have all these businesses in all different parts of the economy, again, that have been around for, in some cases, they have roots going back to the 1800s. And they've kind of developed this dominance in kind of niche markets that have grown through economic cycles, and we believe will continue to grow.
Okay. Your U.S. fund's a little bit behind the index because you haven't been in big tech, basically. You've got Broadcom in there, but you're not super concentrated.
Correct. So, correct. To your point, we haven't. We're actually been pretty happy with how we've done this year, given that we don't have NVIDIA or Meta, and I think combined they're like 550 points of the S&P this year, or something like that. And again, we're fairly diversified as well. So, we have roughly 35 or so names in the portfolio at any given time. And we don't necessarily want to have a super concentrated investment because, again, we're looking for a collection of these, what I would call these structurally advantaged business models to compound our investors' capital.
Yeah, only a percentage point behind S&Ps without any of the major heavy AI players. I mean, I guess you're loving the rotation potential here because if the cyclical stuff starts to pick up, I mean, I would think that your fund is in the right place, right time.
Yeah, and to your point, we started to see that earlier last week, or I guess middle of last week, around the inflation print. So as folks kind of get out of plowing all the capital into a handful of names and start to have a more broadened approach to the market, we feel our companies are going to be really well positioned, and they have been positioned well for decades.
Okay.
Just sometimes they're not as loved.
Sure. Yeah. Well, that's only as close as you are with having a more kind of cyclical skew is pretty impressive. So we'll definitely look for some of that kind of industrial theme when we're watching this market, try and find some new plays. You guys might have some insight for us. They're looking at the fund. Great stuff. Andrew, thank you for your time. Appreciate the deep dive.
Great. Thank you so much, Oliver. I appreciate it.
Yeah, absolutely. Interesting approach and one that might be coming a little bit more in vogue as the market is interested now in some of the more cyclical plays of the market.